Let's take a look at US equities today because we have some events on the calendar next week, but specifically the Nasdaq has been outperforming recently, surprising many as to the strength of its rally, up over 2% on Friday. And in the last 2.5 weeks, it's up over 10%, despite yields in the US continuing to rise. So in today's video, we'll look at US equities. Hello and welcome back to our channel. My name is Daniela. Before we get into this video, please like, comment, subscribe, and turn on your notifications. So as I was saying, US equity showing some strong resilience in recent weeks, but I do think it's important to mention here that the Nasdaq is a key outstander in this recent rally. We've seen some strength in the S&P 500 as well. We'll take a look at the Russell 2000 also because it is a key proxy of the overall health of the economy, but the Nasdaq definitely outperforming. As I said, up over 2% on Friday, a strong rally there. And yes, we had seen US yields pull back in recent weeks, mostly on the back of that weaker than expected jobs data in the US. But nonetheless, they do still remain elevated. 10-year yields up around 4.6%. And we have seen them rise throughout the last week after that pullback. So we're kind of seeing a little bit of a breakaway for the Nasdaq here. As I said, up 10% in the last 2.5 weeks. Now let's review, because on Friday, when we saw this Nasdaq rally that was driven mostly because of the tech sector, we actually saw Moody's, one of the rating agencies, downgrade US debt or US credit to negative from stable. As I said, and if you look at the markets, we didn't really see a negative reaction on the back of that. Usually when this happens, we see yields rise, bond prices come down, the equity markets come down as well. It gives kind of a negative sentiment to the market, and yields rise as investors demand more to hold this debt that is now seen worse off. That didn't happen. It's also important to remember that a few months ago, we saw the same negative downgrade by Fitch. That did cause a bit of turmoil in the markets. That was more unexpected. I think given what happened, this first initial downgrade a few months ago, markets were expecting this to happen eventually. They were expecting Moody to follow suit. Of course, they cited large deficits, fiscal deficits, and also the downgrade in debt affordability. Again, none of a surprise here. We've seen a lot of turmoil this year with the debt ceiling being pushed back and not agreeing on it. We've got, of course, the elections next year. And when that happens, we see a lot of playing with fiscal policy in order to kind of get approval from voters. So it's not surprising that we've seen this downgrade. And as I said, not much of a reaction in the markets on the back of that. Fast forward to now, this week is going to be quite a busy week on the calendar. Last week, we didn't see much data out in the US, and we came from the Federal Reserve meeting the week prior where Powell continued to say the Federal Reserve will be data dependent going forward. Well, this week is going to be key for data. Tomorrow on Tuesday, we have US CPI for the month of October. It's going to be key to see this figure. As we know, the Federal Reserve has a dual mandate of stable employment and stable prices. Employment does seem to be moving in the right direction. As I said, the week prior, we saw a worse than expected data from the US in the jobs market. We saw the unemployment tick up slightly. We saw the NFP coming in below expectations. Nothing too dire, but definitely showing a loosening in the jobs market, which has been very, very tight for the last 1.5 years. That is a move in the right direction. Despite the worse than expected data, it is a move in the right direction for the Federal Reserve to kind of bring inflation back to its 2% target. A softening in the labor market, and especially in average hourly earnings, so in wages, does kind of prove the point that it's a step in the right direction towards this goal. Now with CPI, markets actually expecting, and there's a pretty broad consensus here of core inflation to remain unchanged at 4.1%. Now the reason why I'm mentioning core inflation is I think there's going to be a lot of focus on this. Headline inflation is expected to drop slightly year on year and month on month, but core inflation is expected to remain unchanged both on the monthly and the yearly reading. 4.1% is still a very high level. It's too high for the Federal Reserve. And I think it will actually be the first time that core inflation does not drop in a year if it does, in fact, remain unchanged at 4.1%. It kind of goes to show that excluding the volatile prices of energy and food, which have fluctuated quite a bit in the last few months, prices in the US are struggling to come down. The disinflation process is non-linear, as we know, and it's a lot more sticky than expected. Shelter being one of those big costs that apply to this figure. But as I said, markets are going to be focusing quite a lot on that figure. I do believe if we do see inflation, core inflation actually drop below 4%, it will be a very positive surprise for the market. I think we see a relief rally in bonds or a relief sell-off in yields. That, of course, we'll see an end of year rally continuation in stock market. So I think a reading below expectations will actually really reignite some positivity in the market, especially for the stock market. I think the likes of the S&P 500, the Nasdaq, even the Russell 2000 could actually see a healthy rally on the back of this if we do see the figure come in below 4%. If it comes in line with expectations, I think we just see a rebalancing of recent momentum. I think we may see a little bit of a pullback on the Nasdaq on the back of that. I think yield not necessarily rally significantly, but they do hold around current levels that may be potentially rising a little bit. Now, if we see a reading above expectations, above 4.1%, highly unlikely at this point. But I think that's when we see a little bit of chaos in the markets. Given it's the least expected one, I think that's when you definitely see yield shooting up and the likes of the stock market pulling back on that, as alongside gold as well and oil, which could see some negative bias there. So that is most of what to expect this week. There is another event that's quite important on the calendar. We've got, of course, the Biden and Xi meeting this week. I think they're meeting on Wednesday, if I'm not mistaken. There's going to be quite a few topics debated, including military involvement, trade sanctions and trade relationships, the discussions of the ongoing wars in Israel and Russia and Ukraine. As I said, it's likely going to bring a little bit of a positive sentiment. The fact that communication seems to be open once again. I think this is only the second time that Biden will be meeting the Chinese president since he took office in 2021. Of course, the US shooting down that Chinese spy balloon earlier this year did kind of sever that relationship and that communication between both of them. So I think this is a step in the right direction. I think markets are seeing this as a little bit of a positive in terms of the narrative. I don't think there's going to be too much focus on that unless something significant happens. It's just something in the back of everyone's mind. I do think this week the key focus for equity markets and fixed income markets and FX markets as well is going to be the US CPI data, followed by the US PPI data also, which could bring some further momentum. Let's jump onto the chart now to see how the equity markets have been performing. Okay, so here we are. Let's start with the Nasdaq. US 100 here, Capital.com via TradingView as always. As you can see, this strong rally here on Friday, up 2.15% at the end of the session. But the rally really taking hold all the way back here from the lows on the 26th of October. From here to the peak, around 10% rally in the last 2.5 weeks. So significant moves for the Nasdaq. Of course, we've had the earnings season throughout this 2 weeks. We've seen an okay earnings season. I think we've seen the drought in earnings kind of being over right now. I think earnings are a few steps ahead of the economy. So the worsening in earnings have now kind of been priced out of the market. And I think the tech sector has done pretty well, which has helped the sentiment in the Nasdaq. As you can see here on the chart, we've broken above the descending trend line here, which started back on the highs of July. Breaking above that, quite a significant level. And as you can see, it's acted as support already. Back here on Thursday, we saw an attempted pullback from sellers trying to undo some of the recent gains. You can see acted bang on support here, just around that 15,170 area. So quite significant already. It may continue to be the case that we do see this level hold of support if we do see the pullback once again turning lower. As I said, of course, the US CPI data are going to be the key event this week. So we'll need to watch out the likes of the Nasdaq and also the S&P to see how exactly markets will react. If we do see a reading below 4%, expect to see some follow through in this rally, continue to push higher, potentially all the way up to the highs that we saw back here in July, just around that 15,935 area. That, of course, is just below the highs that we saw back here in 2021, just around that 16,700 level. As you can see, the Fibonacci figure starting back then. So we're roughly around 78% of the losses being undone after pretty much 2 years since that peak. So we are continuing to bring that momentum higher. As you can see, the RSI continues to show some room here to push further before it is overbought and therefore the sellers come in. So we do still have a way to go. I do think the catalyst for this next push could be, of course, the data that I mentioned coming out tomorrow. Today, we may see a little bit of a pullback. Again, that's healthy within a bullish rally. To see some attempted pullbacks that are then kind of priced out just shows that it is still a two-way market and it's not getting too heavily overbought. As I said, the RSI still has room to go and potentially going to push all the way up to the highs here of 15,925 if we do see some further bullish momentum coming in. Let's take a look also at the Russell 2000, the small cap stocks, one of the most economically sensitive indices in the US. As you can see here, quite of a stark contrast to what we've seen in the Nasdaq. Yes, on Friday, we did see around 1% gains, but that comes from a heavy sell-off prior on the week. On Thursday here, down around 1.5%. As I said, a stark contrast to what we've seen in the Nasdaq. Now, we did see a significant rally in the prior week here for the Russell 2000. On the 3rd, that's when we saw the weaker than expected data from the jobs data. And also here on the 1st, that's a Federal Reserve meeting. Markets kind of taking the fact that we were going to see no further rate hikes from the Federal Reserve. Of course, that would be positive for growth. The Russell 2000 being, as I said, the most economically sensitive, taking some positive sentiment from that, pushing higher on the Wednesday, the Thursday, and then the Friday. As the US jobs data came in weaker than expected, yields pulling back, allowing the stock market to take advantage. But then that reaction there, as you can see, as I said, the worse than expected jobs data, even though it's good for the Fed's mandate and given the way it's been behaving in the last year and a half, it does start to show weakness in the underlying economy. And of course, that weighing slightly on the Russell 2000. So it is one of the hardest equity indices to trade right now because it is pretty much, it has a double-edged sword with a lot of the data that comes out. It can be something positive on the one hand, but then have quite of a negative implication as well. So we're now, we broke below a key area of support in the week prior. We came above it, found some resistance there along the 50-day simple moving average, now hovering back again to around that key area of support. Some sideways consolidation continuing, as you can see, pretty much here since the beginning of the year. We've seen a clear resistance on the top part of this and then some support. We've actually broken down below the lows from 2022. So again, making headwinds there with the sellers. But the fact that we did reverse higher and now hovering around that area of support could start to show that we've got some buyers coming in interested to keep the momentum going higher. Of course, the data out tomorrow, US CPI, if we do see it drop below 4% or coming in below expectations, I think the Russell 2000 is definitely going to be one to watch. I think that positive momentum could really come back in, testing once again the highs that we saw just around 2 weeks ago now. They're just around 1,770. That is it for today's analysis on US equity indices. Thank you so much for watching and don't forget to subscribe to our channel.